Hey, welcome to the MMC University. Again, my name is Ernest Joseph. Okay, so we're gonna do a session for you guys that in the beautiful state of Ohio. It's not just Ohio. I think this could be for any state. Get your water, your coffee, or maybe your tea. And you say, fasten your seat belt so we can get to this, okay? We're gonna go to this. Let me see if I can make it a little bit bigger. Okay, I think that's big enough. All right, so you fasten your seat belt. We're gonna get this thing started right now. So let's go ahead and pay attention, okay? And I'm gonna cover this. This information in this chapter is very important. And that could be from pretty much any state, okay? It's not just for Ohio, any state can use it. And really appreciate you guys for leaving those comments and those thumbs up. And if you share, I really appreciate that. All right, so except the one thing I can tell you guys, I'm not sure how long those videos are gonna be on YouTube for free. Okay, so take them, use them while you can. Okay, all right, because sometimes we do the best that we can. So sometimes the information probably changed, then we have to go back and do some update, whatever, you name it. So hopefully while we're doing this, that information is still current. But most of this information I'm about to cover here, it's good so far. All right, so let's get to work. Hope I don't come too loud or too low, but if it is, put your volume down because I'm somebody that talk loud anyway. Okay, so if you pass your exam already, congratulations. All right, let's talk about this section. You're gonna talk about a lot of taxes and things about insurance. Okay, what is earned income? Let's discover what earned income. Earned income is any money that you get paid from a salary, wages, or commission, but not income from investment or unemployment benefits or similar. Because you have to know earn income. Because the reason I'm covering this, because there is some investment. In order for you to participate, you must have earned income. Like you have to be working in a job, or maybe you got to get a commission. So that's earned income. So not residual income, not passive income. What is gross income? Okay, when we talk about gross income, is a person income before taxes. You can see right here is a person income before taxes. So that means that person don't pay taxes yet, is before taxes. There is a concept you have to understand, it's called FIFO. FIFO means that's an accounting method they use. It's called first in, first out. So that's mean if I was investing money, I'm buying stock. So let's say I buy stock last month and I buy stock like 2020 or whatever. Okay, so you buy that stock and you also buy stock today or this month. So whatever stock you buy now is going to be first in, first out. So the stock you buy right now have to be the first one to be sold. Okay, that's a method. Another way is FIFO. I mean LIFO. LIFO means last in, first out. No, my bad. Let me go back. First in, first out. Hold on. So let's say I buy stock. Let me rephrase that for you. I messed up this one. Okay. Let's say you buy some stock back in January 2020. Okay, let me put it this so I can get it right. So 2020 in January. Now we are in 2022. So if you buy stock right now, the stock, let's say you're going to sell that stock now. The stock that you purchase in 2020 must sell first before you sell any stock right now. That's called FIFO. LIFO, on the other hand, if you use LIFO method, that's mean last in, first out. So the stock I purchase right now, if I'm selling, they have to be the first one to get, to sell first before I can sell the one in January of 2020. That's a principle. So make sure you get that. And we're gonna cover that a little bit in a minute. Non-profit organization, of course, not for profit. That's mean if they non-profit organization, that's mean they got a 501c3. So that's mean they're recognized by the IRS, the Internal Revenue. Okay. Policy endowment. What is policy endowment? Okay, we right here. It's in policy endowment. It's a maturity date is when the policy gonna be, time for maturity, maybe age 100, or maybe whatever. If it was 10 years, 20 years, whatever the time you got left to mature for the policy to be end, pretty much end, endowment, end. Policy proceed, of course, that's the death benefits. That's the life insurance proceed. Okay, pre-tax contribution. That's contribution made before tax. That's pre-tax. What is a rollover? A rollover is somebody who have a money same thing into an account, maybe a qualified account, or it could be, sometimes it could be like a 401k, maybe it could be like a 403b, maybe a KEO plan, maybe it's an IRA. So that person have that money today and they roll over to another company. Okay. Surrender. When somebody surrender a policy, it's to give up the whole life policy in case of a surrender. The insurer will pay the insured the cash value that the policy has built up. When you surrender it, that's when you terminate the policy, the contract earlier. Tax deductible. It's a reduction of taxable income resulting in a lower tax liability. So for example, somebody can make $50,000. If they have $15,000 or $20,000 they put into a 401k, for example, that's before tax, that $20,000 will be tax deductible. So that's when they don't really work for 50, they only work for 30. So because 20,000 is not part of the person income tax for that year. Taxable, of course, it's the opposite. If taxable, it's taxable. So the act taxable is when you have to pay taxes on it, subject to taxation. Tax deferred means don't pay taxes now, you pay the taxes later. Vesting. Vesting is the right of participant into a retirement plan to retain the portion of the company money, pretty much. So, or benefits. So if you work for a company, they say, well, we have a vesting for like 5 years, or some of them can even go all the way to 7 years. If they put, let's say you put $10,000 and the company put $10,000, they say you have to work for me for 7 years. If you live like 3 years, you're not gonna get all the money because your part you're gonna have, your 10,000 is fine, but the other 10,000 they were supposed to give you, they might only give you 40 or 60 because you didn't fulfill the vesting requirement. That's why if you have a 401k at your job, before you just quit the job, you need to talk to a financial advisor. Okay, if you don't have one, somebody like myself, then we can educate you what to do so you don't make that decision when you come to your retirement income. Okay, I think that's the key term. So let's get to work. Taxation of personal life insurance. Generally speaking, life insurance, that's supposed to be taxes. No wonder why the premium you pay that is not taxable. I mean, it's not tax deductible. Okay, so that's when you cannot say, oh man, I cannot imagine this year then I pay like $5,000 or $2,000 for my life insurance. Okay, can I deduct it on my taxes? Nope, you can't. That's why when they pay you the death benefit, it's tax-free as well. Okay, you cannot expect both at the same time. So tax-free, the death benefit is tax-free if you take it as a lump sum. If you take it as a lump sum and the person that receive it, they don't pay no taxes. That's another beautiful thing about life insurance. So principal is tax-free, but any interest is taxable. Now listen to me. Any interest always taxable. That's the only way you can pick up that in an exam. Interest always taxable because it's new money to the person who is receiving it. All right. So amount of available to the policy unit. As you already learned, permanent life insurance, hopefully you did learn that, okay, provide living benefits such as cash value. That's what they're talking about. Cash value, living benefits. So the cash value, what you need to know is accumulate, okay, where the policy unit can borrow against it. The policy owner can borrow against the cash value, okay? And or maybe they want to surrender the policy. They want to cancel the policy. So they're not going to lose their cash value, okay? But you have to also know cash value grow tax deferred. You can see it right here. Cash value grow tax deferred. That means you don't pay taxes right now on your cash value. You pay taxes later. But if you withdraw the money and they give you more than what you put in, the difference will be taxable. Okay, I'm going to give you an example in a minute, okay? Upon surrender or endowment, we'll learn the words. So that means when you terminate or cancel or done or make an end in that policy, any cash value in excess of the cost basis. Cost basis means the original price, the original money that you pay. So if I see the definition of cost, this is the original purchase price of the security. So that's the cost basis. For example, if let's say if I purchase a stock for $10,000, okay, it costs me 10 grand. That's the cost basis. If you go to 15, so the cost basis is still 10. So the difference is 5,000. So the 5,000 is the one that I have to pay taxes on. So it's taxable as ordinary income. Now hear me. The difference you have to pay ordinary income. That's been full tax, not capital gain. That's when you have to pay just like you're working into a job. So if you pay 10,000 to that cash value, you have 10,000, okay, and they give you 15, so 5,000 is a profit. So you're gonna pay taxes on the 5,000 as ordinary income, not capital gain. Be careful on that exam. Upon the death, the face amount is paid, and there is no more cash value. Death benefits generally are paid to the beneficiary income tax free. So as you know, there's no tax. If you need to take breaks, you can do that. But unfortunately, I gotta keep going. Let's talk about the dividend. Okay. Let's go talk about dividend. Now, dividend, since dividend are return of unused premium, okay, so I know some people say, well, Ernest, you don't understand. Why you explain it like that? I don't know, maybe that's the best way I know how to do it. So the dividend is not new money to the policy owner, folks. Dividend, it's because now they don't want to say that to you. The insurance company overcharge the policy owner too much money, and then they return some back to you. That's why it's not taxable. They are not taxable for tax purposes. So they are not really dividend. They call them dividend, but they return of unused premium. Since we overcharge you, baby, now we're gonna give you some money back, so you can love us because we do such a good job for you. Okay, when dividend are left within the insurance company to accumulate interest, the interest earned on the dividend is taxable. Remember what Ernest says? Ernest said that interest always taxable. Either you get it from the cash value they give you interest. What's his interest is taxable. If you get it from the face amount is interest, it's taxable. If you get it the dividend, the interest from a dividend, it's still taxable. Interest always taxable. It's subject to ordinary income. Every year you earn that interest, you got to pay taxes on that new money, on the interest. The dividend itself is not taxable. For example, let's say that, okay, you have $100 dividend check from the insurance, ABC insurance company. But you say, you know what? I don't want that $100. Why don't you hold that dividend and pay me interest on it? Let's say that interest you earn $50 or maybe $20, maybe $10. So whatever money that $100 bring you extra in excess to the $100 as interest, you have to pay taxes on that. If it is $10, you got to pay tax on the $10 because interest is always taxable. Okay, good. So dividend, a return of unused premium, is not taxable to the policy owner. What about policy loans? Policy loan, okay, the policy owner can borrow against the policy cash value. Okay, you can borrow against the cash value. So when you borrow money, it's borrow money. Now, money borrow against the cash value is not income taxable. When you borrow money on it, they don't charge you. You don't have to pay taxes on that. However, the insurance company, okay, charges interest on the outstanding loans because it's not no money, really. Okay, the cash value is not your money. It's money you can borrow against it, and the company can charge you interest. But you don't pay taxes on the money that let you borrow. Does that make sense? Okay. Policy loan with interest can be repaid any of the following. This is how you repay the interest: by the owner while the policy is in force. So you can repay them that money you borrow with the interest while the policy is in force. At the policy surrender, or if you surrender the policy, or at maturity, they're gonna subtract it from the cash value. So they're gonna take it off from the cash value if you're still living, because you surrender the policy. Or maybe when you pass away, they're gonna take it from the death benefits. Oh, but that's not fair. Ernest, you don't understand. How come if I have $10,000 policy and if I borrow $3,000 and they charge me $1,000 interest, so that's $4,000. Why they don't just get the money that I borrow and let me live with the interest? I mean, the money that I borrow. No, they're gonna take it. So you're gonna walk away with only $6,000. Yeah, it was not your money. It was the insurance money you were borrowing, and they're gonna charge you interest. You gotta pay all that, and you have no say on it. They're gonna take it from the benefits anyway. So know this: policy loan from the cash value are not subject to income tax. Just know that. Don't go to the exam, say, well, you know what? I was listening to Ernest. He told me cash policy loan are taxable. No, I never said that. Water time. Gotta love it. All right, let's continue. We're gonna go to surrenders. We talk about what surrender mean. Make an end of it. Stop. I don't want it anymore. I want my money back. Okay, now that policy owner say, you know what? I don't want this policy anymore because it's too creepy. I want my money back. And the insurance company say, oh, hold up. You want your money back? That's not how it works. Okay, let's check. Okay, some of the cash value received may be taxable. That's the pen. That's if it is exceed the surrender value, you will pay taxes on it. Okay. For example, let's look at this. Consider this scenario. The face amount is $300,000 policy, but the policy owner only paid $70,000 in premium, because all those monthly premium equal to $70,000. But there's a total cash value of $100,000, $100,000. So now the client decided, I don't want this policy anymore. I want my money. Well, the insurance company say, well, there's $100,000 here. We can't get you the $300,000 because you're not there yet. Some people love that. They want to get that $300,000. They think it's not your money. It's for your people behind. What's wrong with people these days? You want to get that $300,000 and you're still living. No, it's called death. If you put in it, I don't want to say that. It used to be like a death insurance. It's not for you, baby. It's for your beneficiary. Why you want to get that $20,000? But the $100,000 that you can get. Now you decided, well, I want my $100,000. Oh, really? No problem. And if they're sending that $100,000, $30,000 of that would be taxable, because $30,000 exceed what they pay, which is $70,000. So they have to pay taxes on $30,000. What does that mean? Let's say this client was not working for that year. Okay, I'm not your tax advisor. You have to get sick tax advice that happened. Okay. So let's say that that client did not work. Pretty much that client have a taxable income for $30,000, and they have to pay taxes on that. Okay, that's enough. Talk to a tax advisor for more help. That's enough for me. Amount received by the beneficiary. General rule, an exception. Life insurance proceeds paid to the named beneficiary are generally tax free of federal income taxation. So I already mentioned if they take it as a lump sum. But what happened if they don't take it as a lump sum? But if you don't take it as a lump sum, well, it's no longer gonna be tax free. The interest you're gonna earn, you're gonna have to pay taxes on it. Not the whole amount, but you gotta pay taxes on it. But if you as a lump sum, you don't have to pay taxes on that lump sum. An exception to this rule would apply if the beneficiary payment results from a transfer for value, meaning the life insurance policy is sold to another party prior to the insured death. That's the only way. If that happens, that's an exception to, or usually it's tax free. So if you transfer it for value, you got to pay taxes. That person that's gonna get it. Know this: lump sum cash payment of life insurance proceeds are tax free for the beneficiary, so you may pay no taxes. What about settlement option? Settlement option, when the beneficiary receives payment consisting of both principal and interest, the interest portion of the payment received is taxable as income. For example, if $100,000 life insurance proceeds were used in the settlement option, paying $13,000 a year for 10 years, so $10,000 per year would be income tax free, but the other $3,000 extra will be taxable because that's an extra $3,000. So know this: settlement option, the principal is tax free, but the interest is taxable. What did that say? Interest always what? I heard you. Taxable. I'm glad you get it. Okay. So let's go to value included in the insured state. The death benefits or the face amount or the proceed or the coverage of a life insurance policy may be included in the insured taxable state at death and subject to federal taxation. That's if there's three scenarios. If that happened, that $100,000 policy that person have gonna include into their state if there's an incident of ownership. Maybe there's a state, the state as a beneficiary. Maybe the transfer of ownership and the person passed away less than 3 years. If any of those three things happen, it's taxable. It's going to be included in the person that passed away, which is in the insured state. So know those three. If you go to a test question and they ask you, which of the following will be included in this taxable state that's been subject to federal state tax, and that'll be those three: incident of ownership, state as a beneficiary, and transfer of ownership. Any of those three things happen and the person passed away less than 2 years, and the third option, which is the transfer of ownership, you have to include into the insured state. Okay, that's all you need to know on that. That's what you need to know. Let's go. Gonna keep going. Okay, now this is gonna talk about permanent feature and tax treatment. Permanent life insurance, the premium not tax deductible, because so you cannot deduct on your taxes. Cash value exceeding the premium is taxable as at surrender, but it's taxable as ordinary income. Policy loan not included in the in income tax, so you don't pay taxes on the policy loan. Now there's a way you pay taxes, but I'm gonna go to that in a minute. Policy dividend not taxable because it's return of unused premium. Dividend interest taxable in the year they earn because it's new money to the person who received it, which is the policy owner. Lump sum death benefit is not taxable, but if it's not a lump sum, the interest will always be taxed. Know this: Taxes must be paid either upon contribution or upon distribution, not both. If tax on one end, will not tax on the other end. What does that mean? Okay, people calling me. What does that mean? Tax must be paid either when you are putting the money, you already pay taxes on it, or when you're taking the money out, you're gonna pay taxes. So you cannot say, oh, I'm not gonna pay taxes. When it's taxes is due, taxes is due. I'm going to talk to you about an important concept that's called modified endowment contract, MECs. Following the elimination of many traditional tax sheltered by the Tax Reform Act of 1984. 1984, a lot of people was trying to hide money in insurance because they want to take tax advantages because they know insurance you don't pay taxes. I think that was a smart move for them, isn't it? But the IRS say, I'm more smarter than you. So since I got some of you doing that, so there's some consequence. You got to pay some fine. You have to pay some. Okay, well, anyway, I'm not gonna say fine, but there's pain gonna come to you. Okay, there's consequence. So many of these our policy were purchased for the sole purpose of setting aside large lump sum of money for tax deferred growth. So those people were trying to hide money in insurance to avoid paying taxes. I think that was a smart move for them. But the government said, I got you. Don't do that to me. So now here's what they did. They come with a rule. They call it 7-pay test. Why they come with the 7-pay test? Is to determine if an insurance policy is overfunded. So the Internal Revenue Service, which is IRS, established what is known as the 7-pay test. What does that mean? Any life insurance policy that fails the 7-pay test is classified as a modified endowment contract, MEC. And once they classify this policy as a MEC, a loss says the standard tax benefits of the life insurance contract. So pretty much it's kind of an insurance, but still it's no longer an insurance contract anymore. It's become a MEC because it failed the 7-pay test. So in a MEC, the cumulative premium paid during the first 7 years may not exceed the total amount for the net level premium you're supposed to pay that require to pay to the policy using the guaranteed mortality costs and interest. So if you pay more in that 7 years and you fail the test, and they're gonna classify it as a MEC. And once it's a MEC, it's gonna remain a MEC. All right. Now, once a policy failed the 7-pay test and it becomes a MEC, it remains a MEC. It's no longer a life insurance. So here's what you need to know. A MEC is an overfunded life insurance policy equal that's failed the 7-pay test. That's mean they overfunded that policy in the 7 years, and that's with a problem. So know this, once a MEC, it's always a MEC. Or you cannot go back, cry to the government, say, oh, I'm so sorry, I didn't mean to overfund it. Can I get it back as a life insurance? No, you can't. I'm so sorry for you. Because you tried to be smart with me. Now I try to be smarter than you. It's not funny, but I gotta laugh. It's just people, man. They're so smart. They make things harder on us. Okay, now the government keep watching us for any life insurance that we have to make sure it doesn't fail the 7-pay test, so they don't classify it as a MEC. Okay. Now, let's continue. MEC versus life insurance. All life insurance policy are subject to 7-pay tests, all of them. And any time there is a material change to the policy, such as an increase of the death benefits, a new 7-pay test required. A new 7 years to start over if you try to increase it. Because we don't know you're not trying to hide money so you don't pay taxes. So whether from a life insurance policy or a MEC, the death benefits received to the beneficiary is tax-free. So that's the only exception. If it's become a MEC, so the death benefit, the person pass away, it will be tax-free. But I'm going to show you some of the trouble with the MEC. Okay. Distribution. Now, the following are taxation rule that apply to the MEC. I'm going to show you. This is the life insurance we're talking about that just turned to a MEC. Remember, everything was supposed to be tax-free. Now, look what happened. Tax deferred on accumulation. So that's when you don't pay taxes right now. As you keep growing, you pay taxes. But guess what? When you try to take money out, any second bullets, any distributions are taxable, including withdrawals and policy loans. Remember earlier we just covered policy loan, there's no tax, but not in the MEC. In the MEC, that's an exception. The policy loan have to pay taxes because now you violate that, it become a MEC, then we're gonna penalize you for that. So you're gonna pay taxes on distribution. Unless if you pass away for this policy to be free, if you try to take money out of it, you're gonna be subject to taxation. Any withdrawals in policy loans. And distribution are taxed as a LIFO basis. That's been last in, first out. So the money that come last must come out first so you can pay more taxes. Known as interest first. That's mean the interest that's coming in, you have to pay tax on it first. So all the growth have to come out first before you start taking the cost basis. It's no joke. And distribution before 815.5, subject to 10% penalty. We only learn this in retirement. Why does it have to be applied to a MEC? Because it become like a retirement account. The same rule apply. Because you try to trick us, so we're gonna trick you. 10% penalty. Unless you're 15.5 or higher, you gotta pay that 10% penalty. You're gonna avoid it. If you're 15.5, no 10%. Under that, taxes, 10% penalty. But that's a MEC. It used to be life insurance, now it become a MEC, it remain a MEC, then all those will apply to it. So the lesson here, stop being slick. Oh man, this thing, you gotta love this material. They're good. They're awesome. Isn't you glad you guys are happy you're learning that stuff? It's a beautiful learning. Okay. Taxation of annuity. As you know, annuity, a portion of each annuity is taxable. A portion is not. Okay. Unless if it is a qualified annuity, that's an exception. If the annuity is qualified, that's different. All of it taxable. But if it's not a qualified annuity, it's part of it that tax. The other part is not taxed. The portion that is not taxable is anticipated return of the principal paid in. This is also known as the cost base. The cost base is not taxable. But the portion that is taxable is the interest earned on the principal. So this is also known as a tax base. So there's a cost base, there's a tax base. The cost base is not taxable, but the tax base is taxable. And sometimes they use something called an exclusion ratio to determine the annuity, which part of it that is taxable or which part to exclude from taxes. They use the exclusion ratio. So the annuitant be able to recover the cost basis, non-taxable. And the cost basis is a principal amount and the amount that is paid into the annuity, which include from taxes, which exclude, excuse me, from taxes. The rest of each annuity payment is interest that has been earned and is taxable. So for example, if you have an annuity, you put $100,000 on it. And when the annuity, you try to start, it's over, it's time for you to take money out. And it's 150. So 50,000 is taxable. So the 100,000 is the cost base. The 50 is the tax base. So you're gonna pay taxes on the 50,000. So let's say every month you wanna take $1,000 from that annuity every month. So from that 1,000, they're gonna use the exclusion ratio to see from that 1,000 how much from it that is taxable. That's what the exclusion ratio. So if you see where you find the exclusion ratio, know that you find that term only in annuity. Okay. Tax deferred accumulation. So when you have an annuity, you don't pay taxes now. It grows, you pay the taxes later. So the money continues to go to you don't pay taxes right now. Taxes are deferred during the accumulation phase. Is when you start withdrawing money and you start paying the taxes. So withdraw interest and principal. When money is withdrawn from the annuity during the accumulation phase, the amount that taxed on a last in, first out basis. That's been LIFO. So annuity, they use last in, first out. Because you know why they do that? Because maybe I give you 100,000 is the cost base, and 50,000 is the 50,000 is the tax base, which is the interest. So if you decide that you want to take out, let's say 100,000. So that 100,000, guess what? Don't be surprised if they say you got to pay taxes on 50,000 of it. The other 50 is not taxable, and the rest of the money would not pay taxes. They might do that, or they might say, "Oh, let me get the whole money." So the 50,000, you got to pay taxes on it first. So let's say from that 50,000, you don't take all of it like that. Let's say you say, okay, you start taking some of it. So whatever money that they pay you last have to come out first. So that's been to pay more taxes. I don't know why. Maybe more taxes or less taxes. Who knows? It could be more taxes, it could be less taxes, but that's the rule. So the last in, it will be the first one to come out. So that's when the interest have to come out first before the principal. So you can pay taxes. Because the government want the money. They don't want you to keep the money forever. Okay? That's the reason. Okay, what about now? We're going to talk about taxation of individual retirement IRA. Okay, so when an annuity is used to fund a traditional IRA, distribution are fully taxable. Okay. If contribution were made with pre-tax dollar and there are no distribution at the required age, there is a 50% penalty. If you're watching chapter 4 on the video on YouTube, and we talk about retirement account, because this is called RMDs, require minimum distribution. So there is a period of time, probably 72 now, they put the age. You're not gonna be tested on the age, I don't think so. 72. It used to be 71, 70 and a half, now it's 72. So when it's time for you to take that required minimum distribution, if you don't take it out, so you can pay taxes that you owe, 50% of that money will be taxable. For example, let's say the government wanted you to take $10,000 out and you did not take it out. So that's mean half of it will be gone. So 5,000 will be gone from it because you didn't take the required minimum distribution. That's what that means. So if you need more help, you need to understand, please reach out to me. I'll be more than happy. It's case by case basis. I'll be more happy to help you understand what do I mean. If you have retirement, you don't understand how it works. Let us know. We'll be happy to take a look at it for you and we can work you through it together. What about distribution at death? If an annuity contract or holder die before the annuitization date, the interest accumulated in the annuity become taxable. If the beneficiary of the annuity is a spouse, however, the tax can continue to be deferred. So if you're an annuity, is your spouse that's the beneficiary, she doesn't have to pay the taxes now. She can continue to let that money grow. But if it's not, taxes have to be paid at the time on that interest. So any unpaid annuity benefits following the death of an annuitant are paid to the beneficiary and are taxable. Remember, an annuitant must be a natural person. That's the person who receives the benefits from the annuity. And there's a whole section on the YouTube channel about annuity. So if you need more help on that, you can go ahead and watch that, okay? So value include annuity estate. If the annuitant, I'm reading on the green, if an annuitant die during the accumulation period, so while they're putting money in, that's called accumulation, pay in period, the insurer is obligated to return all or a portion of the annuity or cash value accumulated in the annuity in accordance with the contract term, which will be included in the deceased annuitant state. So if the annuity has been paid up, the annuitant died during the annuity period, the annuity benefit will be taxable and will be included in the deceased annuitant state as well. What about corporate owned annuity? You're gonna find some company, they put some create some annuity for their people. I think it's water time or tea time. We're more than halfway done. We'll be done soon. Let's talk about corporate. Corporate owned annuities have different tax implication than an individual annuity. So if it is a corporate owned, a growth in the annuity is not tax deferred. So that's mean if they make money, they have to pay taxes the year. While if you was an individual, you don't have to pay taxes now. You have to let it grow. Also, interest income is taxed annually unless the corporation own a group annuity. So what that's saying is, if a corporation own an annuity, so on the growth, they have to pay taxes on it. It's not tax deferred. Sorry about that, corporation. Also, the interest, they have to pay taxes every year. While if it was an individual one, you don't have to do that. It can go tax deferred. This is some tax tax consideration for life insurance and annuity. Premium not tax deductible on personal expenses. Okay. Death benefits not income taxable except for the interest part of it. Cash value increases not taxable as long as the policy is in force. Cash value gain tax as surrender. So that's the gain. The difference between the cash value, the gain is taxed as ordinary income. Dividend not taxable. The dividend not taxable because it's return of unused premium. However, interest is taxable, always taxable. Accumulation, interest is taxable. Policy loan, not income taxable unless if it is from a MEC. Surrendered, surrender value, past premium equal amount taxable. So surrender value minus the past premium, if there is an amount, is taxable. That's when the difference is taxable. Partial surrender. If you do a partial surrender, it's gonna be first in, first out. First in, first out. So whatever I purchase first need to come out first. That's FIFO. Okay, so you find the FIFO and partial surrender, but annuity, they use LIFO. Okay, so let's see what else. Settlement option, death benefit spread even over income period average. The interest payment in excess of the death benefits portion are taxable. And we already do that. We already covered that stuff. Some of those that will be with you. State tax. If the insured own our policy, the policy, and it will be included in for the state tax purposes, if the policy is given away, possibly to a trust, and the other insured die within 3 years of the gift, the death benefit will be included in the state. I already mentioned that already. FIFO. That's the method applied to life insurance only. So FIFO, they use it for life insurance only, and LIFO used for annuities. So the policy owner will receive on the green, will receive the investment in the contract first before receiving any gain in the policy. So they're gonna receive their money first. Then after that, any gain, they have to pay taxes on those. That's why you see from the life insurance, the cash value, so that remember when I showed you the 100,000, 70 was premium. So that 70 is not taxable because this have to come out to them first. Then the 30 that was gain they have to be taxed in. That's what that means here. So annuities follow a LIFO format. So FIFO for life insurance, LIFO for annuities. Simple to understand. Taxation, letter D, taxation of individual retirement account. There's two most common individual retirement. Is it traditional IRA or a Roth IRA? IRA. Anybody, they must have earned income. That's the reason. In order for you to contribute into a traditional IRA or a Roth IRA, you must have earned income. So that's when you have to work, not passive income. That's why this account, make sure you have one as early as possible when you're making money. If you don't know how to have one, call me. I'll take care of it for you. I will show you how to do it. Now, don't get me wrong. If you want to hide some money from paying taxes, a Roth IRA would be a good way to do it. If you don't have one, shame on you, should have one. Okay? But traditional IRA, for example, is tax deductible, but there is a limit based on the personal income. So you can, for example, if you have a, because you can put down like 6,000. If you're a little bit older, 7,000, whatever, because that called is catch-up contribution. Watch the other video, you'll know. They don't test you on those numbers. So if somebody works for $20,000 and they contribute $6,000 into a traditional IRA, so that's when they don't work for 20 grand. They only work for 14,000 because that 6,000 they're gonna deduct it as taxable, not taxable as of right now. So it's exclude the person income. So that's why I call it tax deductible. But if I do the same 6,000 into a Roth IRA, so it's not. I still work for the 20,000. Except now, when my 6,000 start growing, I can have a possibility to get all that growth on it tax-free if it's meet the criteria. Okay. So contribution must be made in cash in order to be tax deductible. So the term cash include any form of money, such as checks or money order. Excess contribution are taxed 6%. So some people wanted, just like they were doing with the life insurance, they wanted to put more money than they expect, so they don't pay taxes, to reduce their taxes. But the government say, well, listen, you can only put 6,000. If you put 7,000 or 8,000 or 10,000 into an IRA, we're gonna charge you 6% on the excess. So anything more than 6,000, we're gonna charge you 6%, unless you're 50 and older and you put 7,000. Anything more than 7,000, and we're gonna charge you. So what you need to know, the excess contribution into an IRA, both traditional or Roth IRA, if it is a Roth IRA, same will apply, 6% on the excess. But they also tax deferred earning. So what does that mean? So that's mean when you put money into an IRA, you don't pay taxes on the earning. So if I put my $6,000, my 6,000 go to 15,000 until I withdraw it, I don't pay taxes. Same thing for the Roth IRA, same way. But distribution into an IRA subject to income taxation. So when you take money out from it, if you're not 15 and a half, 10% penalty, plus you got to pay taxes on it. So there are certain ways you can avoid the 10% penalty. In case you're 15 and a half, of course, or maybe you're totally disabled, or the money is used to make a down payment on a house, but the home cannot exceed 10,000. I don't know where you're going to find that home for 10,000, but whatever. But that's what the rule says. So not exceed 10,000, usually the first time home buyer. So I think that's say that. I think what they're saying is it's not like the home need to be 10,000. Okay. I think what they're really saying is, so you cannot take no more than 10,000 from it. Let's say if you have $100,000 on it, you cannot take no more than 10. Okay. Withdraw are for the post-secondary of education. If you're going to take the withdrawal because somebody going to college and things like that, maybe get a master's. So then that's fine. You don't have to pay the 10% penalty. You still have to pay the taxes. Okay. Withdraw are catastrophic medical expenses, or maybe the person passed away and they can avoid the 10% penalty. Other than that, 10% penalty if you're not 15 and a half. If the owner died before the distribution have begun, the entire interest must be distributed in full before December 31st. What does this really saying? What happened if the person who owned the IRA passed away before they start taking money? So that's when the entire interest must be distributed in full. They can take all of it in full, or before December 31st of the calendar year of the first anniversary of the owner's death. So that's when they're 5 years, they can take that out. Or they can take everything in full. After the 5 years, okay, you're gonna have another problem. I don't need to tell you what's gonna happen. It's not part of that exam. Okay. What about your spouse? If your spouse is the beneficiary, they can treat the IRA like their own. Okay. They can let that grow. So based on the required minimum distribution, this is called RMD on their own current age. So that's mean what happened if somebody passed away and they have an IRA? Let's say they were already 72. So that's when they have to take money off. And the beneficiary now, they pass away at 73 or 75. Now they leave somebody else, the beneficiary. And let's say that beneficiary is only 50 or 60. No, let's say 50. That person can continue to let that money grow if it is a spouse. And it's fine. They don't have to take the minimum distribution. That's the beautiful thing when you're married. You can put your spouse as a beneficiary and they have some leeway. But anyway, 72 years, they have to take an RMD. All right. Me, I think that's pretty much it for that. I don't have to stay here. Because if you want more information, that go watch the chapter 4 on YouTube. I already cover all that stuff in there. The Roth IRA contribution are not tax deductible, and excess contribution also subject to the 10% penalty. But you need to do this. Traditional IRA distribution are tax deductible, but Roth IRA distribution are not tax deductible. That's what you need to know. And no, the 59 and a half rule is applied for both. If in case you go on it before that, you got to pay 10% penalty. Okay. Now the Roth IRA, you're only gonna pay taxes on the growth if you're 59 and a half. But on the Roth IRA, you have a chance to also have a tax free if you're 59 and a half and the account open for at least 5 years. All this cover on that section. This is the review. So how does traditional IRA and a Roth is the same? They 100% contribution to income level. So that's mean if I can put 6,000 into the traditional, I can do the same thing on the other one, which is the Roth IRA. Excess contribution, both gonna charge me 16 penalty until I withdraw the money. So if I put 10,000 into a Roth IRA or traditional, if I don't take the other 4,000 out, they're gonna continue to charge me 6% until I withdraw it. So don't do it. So this is the difference into the traditional IRA. It go tax deferred, go tax free if the account open for at least 5 years. I already mentioned that, and you're 15.5. Contribution are tax deductible, but contribution is not tax deductible. It made with pre-tax dollars, that's mean before tax, but it made after tax. That's why it's not, you don't pay taxes on the cost basis. If you wait after 15.5. If you need more information on this, folks, you can just come in and talk to me. I'll talk to you, case by case basis on this. Because I know this kind of, for some people, are a little bit complicated, but it's not. It's simple. 10% penalty if you're not 15.5. Both. Qualified distribution cannot incur. Account is open for at least 5 years. So some exception apply, of course. All right. So distribution are taxable. Distribution may not taxable. So not taxable because why? Because you already pay taxes on it. Payout must begin 72. But that's what I love about the Roth IRA. No required minimum age. You can keep this forever. And your family can have that after you're no longer here. And it can continue to go tax free for them. Beautiful way to save money. I'm not doing advertising for them because they didn't pay me for that. All right. Rollovers. You can roll over an account from one trustee to another trustee. So you can, how do you roll over? Trustee to trustee. Now, what you know about rollover as well, you got 60 days to roll the money from the plan. 60 days. That's called a 6-day rollover. After if you withdraw the money, let's say they send it to you, if you don't have paid the taxes, if you put the money into another account 60 days, you might avoid the taxes. But what happens if you call the company directly? Let's say you work for ABC company and you no longer work there and you have a 401k there. You call them up, hey, I want my money. Guess what they're gonna do? They're gonna withheld 20% for withholding. Why they do that? I don't know. That's what the administrator and the custodian gonna do. Don't say, Ernest, why they do that? I don't like them because of that. Well, I'll just tell you the rule. If you want to avoid that 20% withholding, then you need to talk to your advisor, like myself, then we'll show you how to do that. This is known as a direct rollover. Any direct rollover, there's a 20% withheld. In term transfer or direct transfer. So it's referred to tax-free transfer. That's when you can from trustee to trustee. So that's called a direct transfer. Trustee to trustee. There's another thing that's very important you might need to know. It's called a Section 1035 exchange. What that's saying is somebody who have the IRS, I mean, not the IRS, the Internal Revenue Code. They come, include the IRS, they come in with this deal where they say, you know what, if you have a whole life policy, you can exchange it to an annuity where there's no tax consequences. Or you can exchange to the same type of policy, a whole life to a whole life, no tax consequences. That's why they come with the 1035 exchange. If they ask you, how can somebody exchange a life insurance to an annuity? What they can use to avoid taxes? You use the 1035 exchange. So a life insurance policy for another life insurance, you can do that. That's okay. An endowment contract for another endowment contract or an annuity contract, you can do that. So that's been a life insurance with life insurance, you can do it, okay? Or you can do an annuity contract. So that's again, a life insurance, I can exchange it to another life insurance. Or I can exchange to an annuity. Or I can have an endowment contract, which is a MEC. I'm an endowment contract, my bad. A policy that's going to be in, I can exchange for another endowment contract. Or I can exchange to an annuity. And I can also exchange an annuity to another annuity, but I cannot do a term to your whole life. Does that make sense? Or I cannot do a term to a life insurance, okay? Note, Policy owner may not exchange fund from an annuity into cash value policy. So you cannot come from an annuity to a life insurance. That's not going to happen. But you can form a life insurance to an annuity. Annuity to life insurance is a no-no. Nor would the term be used in okay, term cannot know because why? There's no cash value. The key is that an exchange, the exchange may not be from less tax advantage contract to a more tax advantage contract. You have to be same to same if acceptable. All right. So 1035 exchange, know what to use it. Okay. So with this, and you'll be able to get it, and with the notes, what you cannot do. So note this, a 1035 exchange is a non-taxable exchange of a cash value of a life insurance or an annuity on the same life. So that's what you got to know. Now, this is a chapter recap. You can go ahead, you can read that if you want to, but I don't have to go through that right now, really. Let's talk about life insurance, taxation of it, annuities, IRAs, Roth IRAs. If you don't see they say they just put IRA, just automatically know is a traditional IRA. So that's mean it's not a Roth. A Roth IRA, they're always gonna mention Roth IRA. If they don't mention it, it's a traditional IRA. And know about the 1035 exchange and learn about the MEC. And you call it a day. And you know what? You go ahead and pass that test because you can. You gotta believe in yourself that you can do this. The test is not hard, but it can be complicated.